Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Tré Bynoe, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Behaviour Wealth. For more information, check out the show notes on my website, tradebynoe.ca. If you want to learn more about me, start with episodes 1 and 2. Okay, this episode is salary versus dividends. So we're going to kind of put together a little bit of the stuff that we've learned about corporation stuff and help people think better about the decision salary versus dividends.
Yep.
Okay. And part of this will lead to other questions, but we'll get to other CPP related questions later. So off the bat, why do you think this is an important decision?
Tax. I'm going to say like tax implications, it's strategy. There's probably rules for both, and you're going to tell me how one benefits one situation and one benefits the other situation.
Yeah, it's one of those questions that a lot of people have, a lot of business owners have. Are you okay?
Oh yeah. I'm just breathing, but I can't actually breathe normal because
Okay.
I have issues.
Okay. So it's one of those questions. It's a really common question, and the decision matters a lot to your ability to create long-term wealth.
Mhm.
Okay. So off the bat, the majority of accountants out there, like compliance-focused accountants, and not the planning type of accountants, but the compliance ones, the old school type of accountant, will immediately say just dividends. Dividends are the correct way to do it.
Mhm.
And then there's planners that do enough planning to be able to weigh in on the topic will say salary is a great way to go. The truth is it's not really a salary versus dividends. It's a what percentage of salary versus what percentage of dividend should I really be taking there. The best outcome is typically a mix of the two.
Okay. Yeah.
So first off, it isn't a one or the other. It's just a mix of the two is going to be the right answer in the vast majority of circumstances. So I'll start off with what the actual tax result could be, if that makes sense.
Yeah.
So here I have a calculator that you can see. And so we'll say that the business is earning, let's keep this simple. We'll keep it below the small business. So we'll say the business is earning $500,000.
Okay.
And the second part of the equation that you need to know to be able to answer the question, what do you think it is? I always come back to it. It always ends up as the first thing that you have to do.
Net worth.
No, not quite.
Come on, that's usually
that's one thing you should be tracking. Yes, correct. No, it's something that always comes up when I'm talking about like order of operations and things like that.
So the first one was what? Income?
No, the business income.
Yeah, so that's the first thing.
That's one of the things that I need in order to be able to do this calculation.
And you're asking for the other thing?
Yeah.
Expenses?
Yes.
So you're figuring out the net worth. Is that right?
No.
Okay.
Not even close. You're just obsessed with net worth.
It's net worth. The answer is always net worth.
No, so it's what is needed. Remember, I say cash flow. You have to master your cash flow in order to be able to do any true financial planning. Any optimization, cash flow needs mastering. If you cannot master your cash flow, all planning is for nothing. There's no point. What I should actually do, I should have 2 tiers of fees. One for people that come to me with a budget and a proven way to keep to a accurate number, and one for everybody else. And everybody else is going to be, just like within, they can tell me what their spending is going to be within like 10%, I think that's a reasonable range.
Yeah.
The amount of people that will say, hey, I spend like $50,000 a year. I don't know where the money's going. And you look and it's like, okay, you're spending $150,000 a year. There's not quite, there's a big difference between, that's where the money's going. But yeah, no, you need to know what you need. You need to know your cost of living. Fundamentally. So 2 inputs here, we put in the business income and then how much cash that I need. So we'll put business is earning $500,000 and we'll say we need $180,000 to cover our cost of living. Okay. Mm-hmm. We're in Saskatchewan. So what does it show? So it shows that if you was to take one or the other, so this is why a hybrid approach is often the best. In this case, you would get to keep $12,272 more in your pocket if you paid out dividends. Okay, so this is we'll start with dividend one. So in order to get this $180,000 personal, it means that we'd need $247,000 of dividends. The total tax that we would pay is $117,000 in total.
Okay.
Okay.
Yeah.
On the year between the business and.
So this is like, when it says total dividends, that's your gross. Like, what, profit?
No, what has to be paid to me personally.
Oh, and then once it's in your name, you pay your income tax.
Yeah, so I need
117.
No. So I need $180,000.
Yeah.
My business is making $500,000.
Okay. Yeah.
Okay, so then this is where the next step in planning comes into, and why a lot of planners just leave it. Mm-hmm. So you can't think of it as like right now, if you get paid, you don't have the option of leaving it in a company or not taking it this year. But with this individual, their company is making $500,000. Mm-hmm. They need $180,000. And the goal is to find out the best way to give them that $180,000.
Yeah.
So then we need to look at how much tax the business is going to pay and the person is going to pay.
Okay. So this 117 isn't just their income tax.
No, it's what is paid on this $500,000 to get $180,000 out.
Okay. Yep.
To spend personally. Does that make sense?
Yep.
So on this, you'll pay on this total transaction, this total year, $117,000. So that includes what you're going to be paying personally and what the business is going to pay. Okay.
Yeah.
And then what's left over can be invested or whatever the strategy is. Okay. Then the salary, if you was taking the exact same thing, the salary is, you'd need to take a $283,000 salary to get $180,000 net. Mm-hmm. Of that, in this total transaction, in this case, $129,000 is sent.
But it says CPP.
Yeah, and then it shows the CPP contribution
that
has been made, $8,860, basically. So what you will often see is that the CPP is a major factor when it comes to determining how much you get from salary or dividends. Okay, so the reason that a lot of accountants will say it's not worth it is because you have to pay the CPP amount. So that's less money that you have to spend or to invest today. Yeah.
So if you take salary, the reason your tax, like the reason the money that you send to the CRA is higher is because part of it is going into is a CPP contribution.
Yeah.
And that's it. So it's not, it's for majority. Later.
So yeah, but then there's an argument about the CPP, which we'll get to CPP later. Okay. But there's an argument around the CPP. Yeah, for sure. Okay. So that's fundamentally the two differences. Okay, so dividends, you don't pay CPP. Salary, you do pay CPP, but you also get RSP room. Okay, so like in this case, in the salary case, you've generated $32,000 of RSP room. And do you remember what RSPs do?
Move income from one year into another.
Yeah. So in this case, if he was to then contribute, this individual was to contribute the $32,000, it means that they would move income in a year where he had a high income to ideally a year where he has a low income.
Yeah. So does that mean out of that 180, he can now put 32 if he wants to?
Yes, if that's yeah. But then I would assume that the right way to do this is that you have extra money above and beyond what you actually need personally, because you'll have other needs personally that you'd want to accumulate for over time. But
like the 180?
yeah, so let's say, right, you wouldn't just take 180. If somebody came in, their budget was exactly $180,000, I would want $200,000. So I could put $20,000 aside, if not more, for RSPs, for TFSAs, for things like that. So there would be cash. But yes, $32,000 could be contributed to an RSP.
So why can't the dividend person, why is everything zero for RSP and CPP?
Because you don't contribute to CPP and you don't earn RSP room if you take a dividend.
So if you're a business owner,
yeah,
and you decide you're going to take dividends, you can't like open an RRSP?
You don't earn any RSP room.
So you wouldn't, even if you open one, you can't put anything in it.
Because you aren't earning any room.
That's so weird.
It's not, the RSPs are designed for salaried individuals to earn, like to be able to save for retirement and stuff, right? You forego that if you're earning compensation by just owning the company. Remember we looked at the difference between other income and dividends?
Right.
So
for taxes
and stuff. So this is the same thing where with a salary, it's all taxed in other income. For a dividend, it's taxed under the dividend columns.
Yeah. Okay.
We looked at. Okay. So that's just that's the rules. So dividends, you do not get RSP room and you do not contribute to CPP. For salary, you do get RSP room and you do contribute to CPP.
Okay.
Okay.
So would you say, maybe I'm jumping the gun. I love to do that. Would you say salary is maybe better for people who are more prone to spending, like, or overspending, because then it forces them to have some sort of savings? Or like when you're thinking of splitting, because if you have the dividend, you could invest it all however you want.
Yeah. So if we look at what's left over after taxes, so after tax cash, that's personal and in the corporation, you'll notice that the dividend holder has more cash left in the corporation. So if I took that salary, I'd have $190,000 left in the corporation. If I took it as a dividend, I'd have $202,000 left inside of the corporation.
Yeah.
Okay.
So that's over 10 grand.
Yeah. About $12,000 difference.
Yeah.
So yes, theoretically, if this individual was then to invest that, you might be able to get ahead for sure. When you look at the overall numbers, if I was to invest it perfectly, deferred capital gains, the way that I would do it, like low cost index funds, minimal, like no bonds, no interesting, like you did it perfectly like that, dividends would win the vast majority of the time because you can. The issue though is most people don't.
Yeah. I was going to say, again, it's always like on paper, this looks good. And then in practice, does it happen?
Yeah. And that's the thing. With a lot of people, it doesn't happen. So,
yeah.
But that aside. So you'll see here though that, so the total taxes, so we can look at personal tax that is paid. And we see the corporate tax that is paid at a corporate level. So you see the both. This is the dividend column, so ends up overall $117,000, and the salary column $129,000. And that difference is really the CPP in there. Okay, then we see the cash, same principles as obviously would apply. The person that's paying out dividends ends up with more cash inside of their corporation than the individual paying out a salary. Okay.
So is the benefit really, like you're not paying more in taxes if you take a salary, are you?
No, because of the CBP. Okay. So you're paying, you end up with less in your pocket.
For now.
Because of the CBP.
But CPP is just the Canada pension plan, right? Yeah. So it's just going into a retirement fund.
Yes, but if you was to, historically, if somebody was to take what they would contribute to CPP throughout their lifetime and invested instead, they would end up ahead.
Okay.
Right? Like we will look at CPP, but ultimately, quick and dirty summary is CPP isn't as simple as that because it's split into multiple sections. So for instance, right now, CPP disability, right, for certain people is really valuable.
Yeah.
Disability insurance is even harder to get, right? If you have a condition, if you have the certain things that, okay, maybe I would want to be contributing to an extra, it's almost like an extra insurance for disability. So it's not just retirement.
There's like other perks.
There's other perks. There's also a survivor benefit. And, like there are other perks. People think of it as apples to apples, but it's not quite.
Never is.
But we will look at that in a future episode.
Yeah, sorry. Now I'm like trying to make it all make sense.
No, and this is so I was explaining to you the other day. I don't know if I've used this illustration on the podcast. Have you used the cog thing?
I can't. You know what? I was just thinking about this, and I'm like, I can't remember if we referenced it a couple episodes ago or not.
Okay, I'll quickly explain it because this is a prime example of that.
Yeah.
Where I don't know if anybody remembers when they were young and they had a pegboard with the cogs on, and it was like gears that you would put in, and you would turn one and they would all turn.
Yeah.
And then if you turn a different one, they would all turn, and they were kind of like all connected. Financial planning is very similar to that, as in think of the different decisions that you can make within financial planning and think of those as all the individual cogs. And when you turn one, it means that it would mean the best decision is different for other areas of the board. And a financial planner's job is to take, out of all those decisions, take the ones that are most impactful for you and then tell you what the optimal thing would be based on the ones that are most important to you.
Yeah.
Right. Because you will never be able to turn all 50 cogs flawlessly to the perfect way that you want it to be. But there might be 5 or 6 of those that are really, really important to you, that you do want to make sure that they are set to a certain direction. I want my family to be looked after if I die. I want to be able to retire at XYZ age. I am comfortable with this type of risk in my portfolio. Whatever it is, often people have certain ones that they want a certain turn, and that's a financial planner's job. And this is very similar to that, whereas there are so many different cogs here, and when you start messing with one of them, it changes everything else.
Yeah.
So CPP is one of those where if you have no CPP, it means you have to save more for your retirement.
Well, and that's exactly what I was thinking. If it seems like you're either letting somebody else take on some of that for you and you're maybe paying a little bit of a price for it, or you're taking it all on yourself and so you have more cash, but again, are you
more accountability and more consequences as well?
Yeah.
Yes, exactly.
Yeah.
So we see the personal amount of cash. Okay, now this is the one that people talk about. So the effective tax rate, and that's what they're so concerned with because you end up with slightly less. But the RSP room is a major benefit. And this is another cog that might impact this is when, I don't know if we've done the episode on asset location yet, but basically different types of investments should be held in different accounts because of the after tax, to maximize after tax dollars. RSPs are one of them where, as I said, if you invest perfectly, you can get around a lot of the benefits of RSPs if you with a corporation, but you have to invest in a very specific way in order to get there. If you are the type of individual that can't handle your portfolio fluctuating the way that a 100% equity portfolio would, and you want fixed income, you want other things in there, RSPs are almost a must in order to be able to do that efficiently.
Okay.
Okay, so if I need to make myself sleep at night and I need fixed income, I am going to tilt more towards a salary heavy strategy so that we can build RSP room so that you can hold the portfolio that you're comfortable with.
Yeah.
If you are somebody like me, where I sleep fine at night, then maybe not. Maybe you are looking at something more optimal and saying, okay, am I willing to do I have an iron stomach for the ups and the downs? Right.
Right.
So that's the basics of what it will look like. Some of the pros, as I said, so there's with the way that it works out. So with a salary, it's an expense for the business. With a dividend, the income comes into the business pays tax, and then it's paid out afterwards. Do you remember that?
Yeah, this is what we just talked about in
Yeah,
a few episodes
perfect.
ago.
So less corporate tax if you pay salary,
Yeah.
but then you end up paying more personal tax.
Yeah.
And same thing for a dividend. So more corporate tax, less personal tax.
But
tax for a dividend.
That part again is like you
Kind of a
explained.
wash.
It doesn't really matter because
No.
they tried to make it somewhat fair.
Yeah, it doesn't really make it. It doesn't make a difference. Okay,
Yeah.
then we spoke about notional accounts, which we haven't spoke about yet, but we will get to them. So with the dividends, there is special tax treatment for those notional accounts that we talked about because we wanted to pay them down. Okay.
Yeah.
With a salary though, you don't get that. Right. So, and remember, we do want to get rid of these account balances for various reasons, but we do want to get rid of them. So there's a downside to just paying yourself salary. Upside, RSP room, depending on the individual. Dividends do not create RSP room. And we touched on the CPP. Obviously, the downside of not paying into CPP is that you don't get any benefits from CPP if you don't pay into it, which means that you have to do the hard work yourself.
Yeah.
Right?
Yeah.
The way that, because dividends are increased in gross up, how would you describe gross up? Remember I showed you the $30, like I said, if it was $100 paid and they kind of do a gross up in inverted quotes where we'll just say that
it was
this much instead and it was a higher amount.
Yeah.
So the thing is that it impacts your taxable income. So any taxable income benefits are impacted by that. For example, if I have old age security, again, I haven't done an episode on this yet, but old age security is clawed back when your taxable income is over a certain level. It means that you then have to. So, for example, in this situation, this individual was paid $247,000 as non-eligible dividends. But if I gross that up, it's now $284,000 of taxable income.
So it's the same.
It's about the same. Yeah.
Look at the salary is 283,700 something. So it's like
it's about the same. So it's still, but there is definitely that impact there.
Yeah.
Child expenses. So this is where we get into the compliance side of taxation, which I'm not going to spend too much time on. But basically, there are other types of the incentives that come from the government tend to be for salary paid individuals, which means a lot of like moving expenses and childcare expenses and things like that. You need a salary in order to be able to deduct those costs and things like that. But that aside, we'll ignore that one for now. Okay, and then the one that I totally understand, complexity. So a lot of accountants will recommend salary or dividends, mainly dividends, just simply due to complexity. It's a pain to, if you were the only individual and you're trying to pay yourself a salary, I could definitely see how you would just be like, it's not worth it. It's such a pain in the bum to do.
Yeah.
That you're just like, it's just probably not worth it. If, however, you have staff that you're already paying salaries to, just you adding another name to the list isn't that much of a pain.
Yeah.
But I could definitely see the case purely from a mental capacity point of view.
Like, is this easier for the accountant or easier
Both.
for... Okay.
Yeah. And it'd probably be like easier for the accountant is relative. I'm sure there's plenty of accountants out there that would pick that just because it's easier, but it would often mean they'd be billing more, right? Which means it's more expensive if they're the ones doing all the remitting. And
it's like, is it actually worth it for the client at the end of the day?
And the numbers would show that it probably is, if depending on the type of investor, depending on the other cogs, right? But, but I would definitely be on the fence of this is an hour saved here is like, I can put that somewhere else in my business and not worth it. Don't want to think about it.
It feels very like all of this feels very decision fatigue heavy. Like when you're talking about the cogs, you start to get to a point where, oh my gosh, I get why people have financial advisors, obviously, because you're having to make so many decisions already.
And if you're trying to be optimal, yeah. Yeah, which is why I know people really like customization. I'm not so sure. I feel like if I could do it anyway, I would just build
a system,
3 systems that clients then
shocked.
opt into. That's really, honestly, that's how I would do it, where it's just a case of, this is the way I do it. This is optimal for this type of person. If you're not this type of person, I have 2 other options. If you don't fit into those boxes, I can't help.
That is so surprising to me.
I know, so surprising. Because you
Trey's
do.
favorite word is system.
You do. It is so many different small tweaks and changes based on small stuff that, yeah, makes a big difference. Even the way you invest. If somebody said to me, which we'll get to in the next episode, actually, but the types of ways you invest lean more towards certain types of tax treatment, which means that would change this whole system if I wanted to use active management versus passive. Anyway, I digress. Yeah, I definitely get it. Yeah. And then, as I said, government grants and credits and stuff like that are typically designed for salaried employees.
Right.
That's who gets the vast majority of government credits. Okay. So there is a general rule of thumb, which is the first place that I look. So when I'm bringing on a client, the first thing I do is check not the first thing, one of the first things in the opening act of working with me. One of the things we do is look at the notional accounts.
Okay.
And the reason why is because the notional accounts are often neglected, and there is a lot of tax advantage to paying them off and out. So a common one that you will see just get neglected is the capital dividend, like the capital dividend account. Money can be paid from that free. Right, no taxes incurred. It's that, remember I was showing you that is that 50% of the capital gain goes into that account. Oftentimes, depending on how long the person's been investing or whatever, that can just go by the wayside and not really thought about. And that's free money just sitting there that you can pull, right? So but that has to be a dividend. It's a dividend. And then there's the eligible refundable dividend tax on hand account, which that's a priority as well.
Good thing they have the acronyms. Like, what is that?
ERDTOH.
And then NE. Oh, that's the nerd.
Yeah.
There we go.
The ERD and the nerd.
If you're starting on this episode, you got to go back to the other one because we're referencing a lot on that other one.
Right? Yeah, it makes a big difference. Yeah. Yeah.
We're building.
There you go. And then the GRIP, the general, we didn't really talk about this, but the GRIP is income that is taxed at the general corporate rate instead of the small business rate. Okay, so it's taxed at a higher rate versus the lower rate.
So is it like if you're in the small/medium gross income? Is that what it is?
It's like business. No, it's net income. It's business income.
Oh, okay.
So, but I definitely know why you're saying that because there's different nets now. Because it's like the personal net income and not business net income.
Yeah.
Yeah.
This is what I'm saying. It's like
that's fair.
It's also, again, late. We have a 1-year-old. This is a lot for this brain. Sorry.
That's okay. Okay, so the decision-making process is, I'll give you the version that works until it doesn't work. You know me. So many nuances, but we're going to go through that version just so people have a framework of how to think about the decision. Okay.
Yep.
So first step that you want to do is you want to clear out your capital dividend accounts, your CDA and your ERD account.
ERD TOH.
ERD TOH, yeah. That means that you're going to be paying out eligible dividends and any capital dividends that are available, because if it's there, you might as well pay it out. There's very little reason that you'd want to be investing inside of the corporation if you can take it out via these accounts, okay? Because it's very little tax, and if it's invested inside the corporation, it's likely going to be attracting more tax, okay?
Okay.
So this is what I would pay out even if you didn't need the income, I want it out, okay? Second of all, you're going to be looking at other expenses, other things personally that may make you want to take a salary over taking a dividend.
Okay.
So some of those are like childcare expenses, moving expenses, Canada child benefit.
What do you mean by moving expenses?
There's just a deductible,
If you like move city or
a certain distance for different reasons. Yeah.
Okay.
Yeah. So that then you would look at that, and then because so here's the thing about them, it depends on the income and it depends on who's doing the work. Okay.
Really?
So
It depends, huh?
Yeah. So if I am doing the work, I'm probably not going to bother because the tax for the time it's going to take me to go through it. I don't know whether I say I'm good. If it was me and my money, I would do that. That's what I would do.
Sorry, clarify that.
If I am a busy executive
Yeah.
in a company and struggle to find an hour to myself, I'm not going to spend it doing that.
Yeah.
I'm probably just going to ignore this part.
Okay.
Simply put, if I'm paying somebody to do it, it's like my accountant, because that's who should be doing this, then I'm going to expect that they did it.
Okay.
Does that make sense?
Yep. Yeah, because you're paying for it.
Yeah, I'm paying for it, right? Like if I'm same as if somebody was coming to me and the accounts are not optimized by location, I would have a problem with that if I was a client. But if it's the client doing it and it's going to take them 15 hours to do it, I might say, okay, well, is it really worth? There might be other places that you could spend 15 hours of your time that might be worth more than the benefit of doing this.
Instead of deciding between RSP, TFSA, or whatever. Like.
Yeah.
Yeah.
Okay.
Okay. Yep.
Okay. So then you would look at the other types of notional accounts. So this is the GRIP account and the non-eligible dividends. It's worth it for a few different reasons, but it can still be worth it. There's so many. I'm thinking of so many different examples and scenarios.
This one's tough. It's basically, it comes down to, it seems that as a business owner, you have to like have all your information for your business and your circumstances and have a nice custom plan and not follow just some framework or system.
Or you change your life so you fit the system.
Change your identity.
Yes.
This is fun. Sorry. I'm sorry. This is a tough one, I will say. Because, it's like, it's hard to give examples and stuff when it's so dependent.
Anyway, I'll keep going.
Keep going for sure. Yeah.
So there's the GRIP. If income is hitting above that amount, the small business amount, oftentimes it can make sense to pay a salary to earn RSP room on that income, then pay the higher amount inside of the corporation and let it sit there anyway. Mm-hmm. Because you're not saving enough by leaving it in the corporation for it to be a landslide decision one way or the other.
Yeah.
See, within a corporation, if you can pick between, and it's at the small business rate, and you could pick between spending 11% of your income goes to taxes right now and you can invest the rest, or you're picking 48% of your income, it's a very easy decision to make.
Yeah.
So it's a little harder when that gap is a lot smaller.
Yeah.
There's a lot more nuances to it, which is why I'm like, I can think of so many nuances that I can't, it's really difficult to give a solid, this is what you should do.
Yeah. But that's anything in finance.
But these are definitely things that you want to be thinking about for sure.
Okay.
Then it comes to
that one looks good.
Income splitting. Then it comes to the income splitting. There is TOSI, so tax on split income rules. There's lots of rules around this. This is where a compliance accountant is perfect, and you love accountants and you make sure you thank them a lot, because you want to be sure that you're on the right side of the spirit of the law when it comes to this. But also this is where planning well in advance comes into play for a lot of people. Just as an overview, an example of that, or how this impacts. If I wanted to start a business today, you would pay for it. So during up until now, when you've been working, you've been saving the money that comes into your account and that goes into savings, right? So it means that we can point to an account and say, that's Sierra's money that she has earned through going to work and earning, okay?
Yeah.
There's a few benefits to that. And one of the major benefits to that is that if we were to start a business, even if I'm running the business, you can pay for the business. And then you're a fully invested owner in the business. Then it's reasonable that you would get a return in dividends on the business. And if I am providing my labor, then it is reasonable that I would be paid a salary. Plus, we'd make an arrangement where I could pull out dividends and stuff as well as a part owner. But it has to make sense. And that's really when you look through the tax laws and stuff like that, it highly favors the people that are prepared well in advance.
Yeah.
Because what often happen is I'm a plumber. I want to go start a plumbing business. And now my wife doesn't really work in the business. And I now want to pay her dividends because I've just realized that I'm now paying almost 50% of my income and my wife next to nothing.
Yeah.
And then the TOSI rules come into play and they say, well, your wife has nothing to do with the business. You can't do that. And you're like, what? Again.
But that's hard. Like, I get it, but I feel like I have a problem with income splitting.
Me too. I absolutely do as
I'm
well.
like, I don't love the rule because when you get married, if you're legally married, you say in your vows, what's yours is mine, and what's mine is mine. Just kidding. But you know what I mean? Like, that is like the marriage contract, and they love to use that in certain situations. But then when it comes to income, it's like, okay, this is the plumber's business, but are we not married? And what's yours is mine. And the government's like, we don't like that anymore.
Yeah.
Yeah,
don't get me started
on for that part.
Yeah, I don't like it either. I think I don't like it. But
yeah,
that's the rule book. So you play by the rule book.
Yeah.
But again, that is an area where planning well in advance makes sense. And it's a part of the reason that we did it that way for years and years and years. So if we ever wanted to, that's an option.
I can go out and buy a business,
right?
Leave you broke on the streets.
Living under a bridge.
Yeah, no way.
Yeah, no. And that's, so yeah. Anyway, you'd look at that. And then you would still nuances here, but you would typically pay yourself a salary after all of that is cleared out because of the other benefits of salary. But again, there are tons of nuances here that I haven't even started to.
Your brain is just like, you have all the cogs in your brain right now going.
Yeah.
And you're like, it's all connected.
And this is where the long-term tax planning comes into play, hitting certain tax brackets and knowing what you're doing for the long term and planning well ahead. And an example of that is, let's say in this situation, I am spending $180,000 a year, but I know that I might not even know what I want to do, but I know that that's my base spend. That's what it costs me to do everything that I want to do with my family and live a great life. But that's what my spend is. But I know at some point, maybe I do want to buy a really nice car. Maybe I do want to buy a cabin. Maybe I do, I would plan ahead of time and be taking more, right? And balancing that tax over multiple years instead of just this one big, hey, I need another $1 million from the company. And you're like, okay, but at this level of gross salary, you're already in the top tax bracket anyway, but you understand what I'm saying theoretically.
Yeah, for sure. Like doing anything in one big chunk seems, when it comes to taxes. If it's a better way,
you want to do it, you want to reduce the overall taxes that you would owe. It also gives you some flexibility. The amount of times when people don't have enough money for a vehicle or things like that because it's all in the company and you're like, well, or they only have TFSAs and you're like, okay, but the TFSAs are really nice for investing, like really, really good long term. So like I don't know. It's just
Yeah.
pros and cons. There's so many pros and cons.
It's hard though, because it's like, again, I feel like I maybe sound like a broken record, but it's tough that you can only plan so well because life is completely unpredictable.
Yeah.
So you can only, like, yeah, you are planning if I maybe want a cabin, if I maybe want a car.
But you put yourself in a situation, or I think you put yourself in a situation where those things are optional.
Yeah.
Versus put yourself in a situation where where you doing those things is really suboptimal, if that makes sense.
Yep. Yeah.
You know,
for
putting
sure.
yourself like even if we never started a business, it's not the end of the world that you have the money that we can point to that says I earned this. It's not the end of the world. It's just it's
Paper
there.
trail.
We've done it. Paper trail. It was easy to do. We systematized it. It wasn't difficult.
But it took
It was worth
foresight.
it. But it takes foresight, right? And that's the thing. It took knowing the rules and foresight for the long term.
Which is, again, like, I feel that is very difficult for a lot of people, and it is a lot of work, I think, because of the decision fatigue. I get what you're saying, because you're a planner, you know the rule book, and you know even how to reference it if you don't maybe know exactly the rule.
Well, there's a lot of rules that I don't know exactly, but I will go. It's
Look.
all there. Yeah.
But yeah, we were talking about this the other day, how it feels like a game, and you, as somebody who has read all these rules, you've read the rule book, but a lot of people are just out here like
Yeah, because another thing I'm thinking of is
winging
that
it.
this plumber individual, if he does have a stay-at-home wife and can't split the income and things like that, you would almost more. I would want to lean more towards his salary so that he could build RSP room to be contributing to a spousal RSP so that she can take the income later on. Seems very obvious to me, but I would do that at 30 years old, 35 years old, knowing that it could be a benefit to me at 55 years old.
Yeah. Again, the knowledge
20, 30
bias.
years. Yeah, you're right. There's a knowledge bias there, which to me, that seems like an obvious. What's the downside to me doing this? If I'm trying to decide between the one or the other, like salary or dividends, and I'm like on the fence about it, it's like, okay, well, this is one positive that might push me well over the edge. So that's the case of, okay, well, I'll take the salary, do the RSP contributions, and do them as spousal. Heck,
again,
if she needed to take it out right now, she could take it out, take the minimum payments, and be taxing her income. And then actually, that's probably what I would do, because then first $15,000 ish of income is tax free anyway. So I would want her to have at least that.
Duh.
And if I have to pick between getting taxed, yeah, you're right. If I have to pick between getting taxed at 40% or I can give it to you at next to nothing.
You're like really, you're going.
Why wouldn't you do that? I don't know why you wouldn't do that. It's
you're
obvious.
really going on a tangent.
Yeah. Anyway, all right, I'll stop. Okay.
But that's what I mean. You have all that knowledge. The plumber does not have that knowledge, most likely, and you're going to find somebody.
It seems really unfair when you think of it like that.
Yeah,
because I'm the prime example of you just do what the rules say and it works out long term. Like even short term works out really well.
Yeah. At the same time, you know me, I love to look at it from every single angle because I feel bad for people like that. But at the same time, it's completely accessible. To read like the tax code, could you not just
Google it? It's on Google. And I would say I have not sat down and read the tax code. That is insane. I don't know who would do that.
I feel like I wouldn't be surprised if you came to me.
Yeah, I've read parts of it. It's very boring. But the CRA does have some really good folios, I think they call them, which is they basically break down a really key part of the tax code and they give examples, and even some of them reference court cases and things like that so you can understand them better. So I would say, even if you don't want to go read all of the stuff, either find somebody that does do that stuff and you trust and build a relationship with, and if it's me, you actually go through the system and work with me properly, because
it's done.
It's anyway. But those folios are really good. They go through all the major planning cogs. Yeah. And there's plenty of them. There's lots of them.
Yeah.
So lots of really good reading.
Yeah.
Okay.
You're having
Anyway.
trouble sleeping, I guess.
Whoa. Okay. Perfect. We will cut this episode there. So yeah, does that make sense? I hope that you got something out of that. It's a big decision, but it is an important one, and it dictates how you will go about building wealth with a corporation. But that's not the whole story, because a major part of this is what are you going to do with the money afterwards, which is why it's so important when you're determining how you're going to do this. You need to know how much money you're going to spend. Okay, so if you take anything away from it, it's, as always, master personal cash flow.
Yep.
First.
It's always net
Comes
worth.
back to it.
Just kidding. And the system.
That's what they
follow the system.
Okay. All right. We'll see you guys in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bynoe, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.